Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the internet's most popular steakhouse a good investment? In this video we will be analyzing if Texas Roadhouse stock is a buy. Could Texas Roadhouse, stock ticker symbol TXRH, be ready to soar even higher? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Texas Roadhouse. Texas Roadhouse wasn't actually founded in Texas. In 1993, founder W. Kent Taylor opened the first Texas Roadhouse in Clarksville, Indiana, inspired by Texas-style cuisine. Their focus on made-from-scratch food and friendly service helped them grow quickly. They offer a variety of menu items including hand-cut steaks, fall-off-the-bone ribs, made-from-scratch sides, and fresh-baked bread rolls. Today, Texas Roadhouse is a publicly traded company with over 600 locations across the US and internationally, with their headquarters located in Louisville, Kentucky. Now let's look at the price action. Starting with the 1-year chart, we see that Texas Roadhouse had a CAGR of about 46%. Zooming out to the 5-year chart, we see that Texas Roadhouse had a CAGR of 26%. Texas Roadhouse has been a juggernaut growth restaurant. Love this share price appreciation. If we perform a backtest comparison of investing $10,000 in Texas Roadhouse versus the S&P 500, we find Texas Roadhouse significantly outperforms the S&P 500 across nearly every metric. A $10,000 investment in Texas Roadhouse would have grown to $32,700 compared to $18,133 for the S&P 500, resulting in a 30.12% annualized return for Texas Roadhouse versus 14.14% for the S&P 500. However, Texas Roadhouse's investment was more volatile, with a standard deviation of 30.14% compared to 18.93% for the S&P 500. Even when looking at year-over-year performance, Texas Roadhouse outperformed the S&P 500, with a best year growth of 41.55% compared to 28.75% and a worst year performance where Texas Roadhouse actually grew 4.13% versus the S&P 500's decline of 18.17%. Texas Roadhouse did experience a larger maximum drawdown of 33.44% compared to the S&P 500's 23.93% drawdown. Finally, Texas Roadhouse demonstrates superior risk-adjusted returns with a Sharpe ratio of 0.96 and a Sortino ratio of 1.68, compared to the S&P 500's ratios of 0.68 and 1.06, respectively. Overall, Texas Roadhouse has outperformed the S&P 500 by a wide margin on a risk-adjusted basis. Now let's jump over to market share and take a look at Texas Roadhouse's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Texas Roadhouse is categorized as a casual restaurant. Expanding the casual restaurant tab, we can see that Texas Roadhouse has the second largest market share of the companies listed, and seems to be gaining market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Texas Roadhouse, TXRH, and see that the market share is 0.56% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Texas Roadhouse attracts a relatively small portion of food spend but has been growing market share. The 5-year market share CAGR for Texas Roadhouse is 13.52%. This means that Texas Roadhouse's market share is far outpacing growth in the wider industry. If we start in 2020, we see that the market share was 0.37%, 0.46% in 2021, 0.48% in 2022, 0.54% in 2023, and 0.056% over the trailing 12 months. I love the nice steady market share gains and don't expect this trend to stop. Let's take a look at the fundamentals to learn more. Gross margin is 17%. This is not much different from other casual restaurant companies. Revenue has compounded at around 24% over the past 5 years and has reached over $4.78 billion most recently. Texas Roadhouse's revenue has been growing very nicely, though the rate of growth has slowed in recent years. When we look at cash flow, we see a 36% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 30% CAGR. As a result, free cash flow has grown at an 46% CAGR. Nothing bad to see here. Texas Roadhouse is growing operating cash flow faster than capex. Free cash flow per share growth is the crux of strong fundamentals for publicly traded stocks. This next metric will give us insight into whether Texas Roadhouse is achieving this goal. Weighted average shares outstanding have fallen over the last 5 years, going from 69.9 million shares in 2020 to 67.1 million shares most recently. Texas Roadhouse has been buying back shares. This is what I like to see. Appropriately, as the share price increased, Texas Roadhouse has slowed the rate of buybacks but is still decreasing share count. This is a great highlight of a strong management team. Now let's view return on invested capital. Return on invested capital has grown from 2.3% in 2020 to 12.8% most recently. While this value is not that high, it is good enough. Furthermore, the trend is upwards, so I would expect this value to continue to improve over time. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 8 days in 2020 to -5 days most recently, Texas Roadhouse has done really well improving the operational efficiency of the company. Another gold star. Now, let's look at Texas Roadhouse's debt. The net debt to EBITDA has fallen over time, going from 3.3 in 2020 to 1.1 most recently. While not negative, this net debt to EBITDA level is fine. I am not worried about the ability of Texas Roadhouse to pay back their debt. Last, let's explore dividends. Current dividend yield is 1.42% with a dividend payout ratio of 46%. Texas Roadhouse is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Importantly, dividends per share for this company have grown at a 16.6% dividend per share CAGR over the past 5 years and a 16.1% dividend per share CAGR over the past 10 years. Though the dividend yield is small, savvy dividend investors are being rewarded with strong dividend growth every year. What is not to love? Texas Roadhouse looks great. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Texas Roadhouse. It is a restaurant company with a gross margin of 17%. The 5-year revenue per share CAGR is 25% and the 5-year free cash flow per share CAGR is 48%. This is stellar growth and a good gross margin. This company is awesome. A return on invested capital of 13% is okay but is steadily growing. Next, the cash conversion cycle of -5 days is ridiculously good and seems to be getting even better. Concerning debt, a net debt to EBITDA of 1.1 means that it will take Texas Roadhouse a little over 1 year of earnings to pay down their debt. So from a fundamental standpoint, Texas Roadhouse looks perfect. Now let's switch our attention over to valuation. Texas Roadhouse is slightly overvalued relative to the S&P 500 with a ratio of 1.2. The price to earnings growth, or PEG ratio, is 1.9, indicating that Texas Roadhouse is overvalued relative to their projected earnings growth. Texas Roadhouse is an example of a great company. There is something to love here for all types of investors. Great revenue and free cash flow growth will attract growth investors. Great and improving efficiency investment and management of inventory pools and investors who love compounding machines. Dividend investors will love the 16% dividend growth CAGR. I really like this company. To further spur growth, management has decided to roll out the restaurant's famous bread rolls to consumers outside the restaurant restaurant by selling frozen bread rolls at Walmart. The 12-pack of mini rolls come in a ready-to-bake pan with a honey cinnamon glaze that mimics the restaurant's honey cinnamon butter. The rolls cost $5.26 per package. Nothing beats the fresh baked bread we make in our restaurants daily. However, we're excited for our guests to have an inspired product available to them to make at home. I don't know for sure, but I imagine these frozen bread rolls will be a huge hit and open up another growth channel for the company. One of the only issues I can see at this time is valuation. But even then, Texas Roadhouse is just slightly overvalued and is actually better valued than other great restaurant companies such as Wingstop and Chipotle. Texas Roadhouse continues to be a champion in the food space. While I would love to see a bit cheaper valuation, the company looks really great. For me, Texas Roadhouse is going on the watch list. Many thanks for watching. What do you think about Texas Roadhouse and their great market share growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.